Hi guys, good morning. Hope you people are doing good. So we are in class number 2 of the revision series. This is class number 2 for derivatives. Remember, we have already covered all the forex concepts in the three classes, and we have done one class on derivatives where I have started with the basics of derivatives, and then we did discussion on futures. Why I am saying all this is because if you are watching this class, then you need to go in the same sequence in which I have done it. Start with forex, then do derivatives class number 1, and this is class number 2 in derivatives. Futures, two important things are left to be discussed. One is, if you remember, we need to talk about the pricing of futures. And if you remember, the pricing of futures is to be done using the cost of carry model. We use cost of carry model for calculating the price of futures. And what I told you is that we have cash market, we have futures, we have current market price available in both the markets, where future price is very close to the cash market prices. This is purely determined by demand and supply, whereas the justified price is what we calculate using the cost of carry model for futures. This is used calculated using cost of carry model. And as far as cash market is concerned, we study equity analysis to calculate the justified price of equity shares. We use different models over there, like if you remember, DDM, dividend discount model, free cash flow approach, that is FCF. Then we have also done PE multiple approach, net asset valuation. These are different models which are used in equity analysis, where you calculate the justified price for cash market. However, in case of futures, the justified price of a future is calculated using cost of carry model. Sir, what is the purpose of calculating the justified price? Answer is very simple. We compare the justified price with the current market price to find out if the share or commodity is overpriced or underpriced, and accordingly, in case of underpriced financial assets, we give a recommendation to go long, whereas in case of overpriced assets, we give a recommendation to go short. I hope this is clear in your mind. Now, coming to the cost of carry model, if you remember, the basic equation is given as theoretical F is equal to S plus NCC. Theoretical price of a future is equal to spot price plus the net cost of carry. If you remember, this net cost of carry is basically made up of four different components. The first one is the interest cost saved. The interest cost saved is basically based on the understanding that because you trade in futures, you will be saving the interest cost, because you only have to pay initial margin and not the 100% amount of the amount, unlike the cash market. But in cash market, we pay 100% money, but in futures we only pay initial margin and we take a position. So you need not pay 100% money, and that is why interest is a saving. If you remember, interest cost saved will increase the demand for futures and the price of futures. Anything which is a saving, trader will be willing to pay a higher price for the futures. Second was the storage cost saved. If you remember this, the storage cost saved is not applicable in case of equity, but it is applicable in case of commodities. Storage cost will be saved because in case of futures, we do not get the delivery, we will only get a position. But in cash market, it's not like that. If you buy something, you will get delivery. So it's applicable for commodities like crude oil, or for gold, or for copper, or for any other commodity which is available in the market. The thing is, if you buy something in the cash market, you need to have a warehouse facility where you can store the things, and you will end up paying storage cost, which is warehouse charges or maybe insurance as well. But if you're taking the exposure in futures, you only have to take a position, so delivery never comes to you, and as a result of that, you save the delivery cost. So this is also a saving. The first one is applicable to both equity and commodity, but second one is applicable only in case of commodities. Next is the dividends foregone. I hope you remember this. The dividends foregone. Dividends foregone is a negative thing. By dealing in futures, you never become the registered shareholder, and accordingly you will not be entitled to dividends that company will pay. And if you buy the share in the cash market, then obviously you will be entitled to these dividends. This is applicable only in case of equity because there is no concept of dividends in case of commodities. And finally, we have done something called as non-monetary benefits foregone. Like, because you're not the owner of the share, so you will not be entitled to voting rights or participation in AGM, and you never have that ownership of a share. So that is the non-monetary benefit which you don't get in this case, because you only have a position, you're never recognized as the owner. Non-monetary benefits, there is no standard methodology for calculating it. The amount of it will be given if they give. Generally they don't give, but if they give, then you need to subtract it, and again it will be applicable only in case of equity. So basically NCC has four components: A, B, C, D. A and B are positives, C and D are negatives. As far as equity is concerned, A, C and D will be applicable. As far as commodities are concerned, only A and B will be applicable, and for commodity both A and B are positives of trading in futures, right? So if I have to write NCC, then NCC is equal to A plus B minus C minus D. A plus B minus C minus D, where A and B are positive, C and D are negative. Now it depends whether A and B value is more or C and D value is more. Depending on that, NCC can be positive or NCC can be negative. Again, if I write the equation is theoretical F is equal to S plus NCC, which means if NCC is positive, then in that case F will be greater than S, but if NCC is negative, then F will be less than S. I hope this is clear, guys. After that, guys, we have discussed that the most simple, let us first understand. We compare actual F and theoretical F. If actual F is greater than theoretical F, if actual F, the market price which is determined by demand and supply, is greater than theoretical F, then we say that the stock is overpriced, and for any overpriced asset, obviously we will not recommend buying it. In such cases, we recommend going short on it. And if actual F is less than theoretical F, it means the future is underpriced, and on such futures we recommend to go long because they are underpriced. I hope this is clear. After that, I told you in exam which is the most simplest equation of futures calculation that can come. That is, future is equal to spot price plus interest saved minus dividends foregone. I hope you remember this, guys. Future price is equal to spot price plus interest saved minus dividends foregone, and this is the basic equation which can be used. Sometimes when you want to use future for hedging or speculation, they will not give you the future price, but they will give you necessary information using which you can use the cost of carry model, and then in that case the future price is equal to spot plus interest saved minus dividends foregone. If they give you interest rates, continuous compounded rates, CCRI, continuous compounded rates of interest, then we use this equation of calculating the price of future, which is F is equal to S into e to the power R minus D into T. If you remember, I told you that this equation is very similar to what we did in IRP. IRP was F is equal to S into e to the power IA minus IB into T. Here we take R minus D into T, where R is the interest rate and D is the dividend which is payable on the stock. And we only consider those dividends which are payable before the maturity of the future. They might give you any dividend which is payable after the maturity of the future. Understand, we are not interested in such dividends, and such dividend information is ignored. I hope you remember that. I told you one more thing, that interest rates, if nothing is specified, we always assume that interest rates are given on per annum basis. Interest rates are always assumed to be on per annum basis. But whereas as far as dividends is concerned, if they write the words per annum, then take it per annum. If they don't say anything, then assume that they have given dividends for the exact maturity of the futures. That is, time adjustment is not required if they don't use the word per annum. I hope this is clear, guys. After that, I told you one more thing. This formula can be used only when dividend is expressed in percentage. This formula can be used only when dividend is expressed in percentage. But if they give you dividend information in amount, if they specify the amount of dividends, then we use a formula where dividend will be reduced from the spot price, and then we do into e to the power RT. So from spot price we will reduce the dividend at its present value, because dividend is payable on a future date, spot price is the price today. From price today you can't subtract the price on a future date, so we take the present value of dividend, and on the net amount we calculate into e to the power RT. This formula is to be used when dividend in amount is given. and the above formula is to be used when dividend in percentage and is given. Obviously dividends, we are talking about dividends, so this formula is applicable in case of equity. And suppose if we have continuous compounding in case of commodity, then instead of dividend we will have storage cost, and the formula looks like this. I hope guys you are clear about it. This is the formula which we use in case of commodities. Why did we add storage cost? Because you already know storage cost is a saving, so saving should be added and not subtracted. Be very careful. In case of dividends you reduce it, because dividends are a loss of income in case of futures, but as far as storage cost is concerned you add it, because storage cost is a saving in case of commodity. So these are the different variants of the formula. Basically there are 4 formulas. The first one is spot price plus interest saved minus dividends foregone. The second one is continuous compounded rate of interest, and if dividend is given in percentage, then we take f is equal to s into e to the power r minus d into t. If dividend is given in amount, then you first remove the present value of dividend from the spot price, and then you do into e to the power rt. If commodity is given, dividends will not be there, but we will have storage cost in that case, and storage cost will be added and not subtracted at its present value. Remember, if the time to payment of dividend is different from time of futures maturity, then you take T star. You see that yellow star I have put over there. We take T star if the time of dividend payment is 2 months and futures maturity is 3 months, or say the time to dividend payment is 3 months and futures maturity is 6 months. I repeat it once again. Examiner may test you by giving you dividend amount which is falling after the maturity of futures. Such dividend information is to be ignored. I hope this is clear, guys. And once again I am repeating myself, if dividend is nothing is specified, assume dividends to be for the exact maturity of futures. Interest rates, like always in SFM, we take it on per annum basis, and accordingly time adjustment will be required. One more thing you need to be careful about, if you read the notes what I have given in the class, you need to be careful whether dividend rate is given or dividend payout is given. If dividend rate is given, then in that case dividend is expressed as a percentage of face value. Dividend rate means dividend is expressed as a percentage of face value. If dividend payout is given, then dividend is expressed as a percentage of earning. If dividend payout is given, then dividend is expressed as a percentage of earning. And if dividend yield is given, then dividend is expressed as a percentage of market price. 3 things you have to remember. Dividend rate is percentage of face value, dividend payout is percentage of earnings, dividend yield is percentage of market price. So you need to be careful about what language they have used. So this is how you use the formula for calculating pricing of futures. Once you calculate the price of future, you might be required to compare it with the actual price of futures, and in some cases they will not give you the future price, and they will tell you very clearly use cost of carry model to calculate price of future. Or even if they don't say, you should be clear in your mind that the only way to calculate the price of future is by using cost of carry model. Hope this is clear, guys. Next, if you remember, I told you as far as futures are concerned, there are 2 topics which are most important in futures. One is obviously hedging currency risk using currency futures, and other is to adjust beta of the portfolio using futures. I hope you remember this point, guys. We have done variety of sums on this, and we have also marked it as very, very important in the class. Before we started this discussion, I did a long discussion with you on why beta, what beta is, where does beta come from, if you remember all this. So we started like this. I'll give you a small summary, okay, because I want to cover everything. If you remember this, I told you the first thing that we do is we calculate RE. RE is the required rate of return of the investor. The question is, why do we calculate RE? RE is basically calculated so that investor can compare it with the expected return on the stock. How expected return is calculated? It can be calculated using holding period return. It can be calculated as summation px. Okay, that is expected return, or it will be generally given to you in the exam. RE is what investor is requiring. ER, expected return, is what the stock is expected to pay. Suppose if my requirement is 18% and expected return is 20%, if my requirement is 18% and expected return is 20%, then in that case we assume that stock is underpriced, because stock is capable of paying me more than my requirement. So we compare RE and ER to decide if the stock is underpriced or overpriced. If ER is greater than RE, it means the stock is expected to pay more than my requirement. That's the exact language I want you to learn so that you never get confused between ER and RE. Expectation from the company, requirement is mine. If expectation is more than my requirement, then for me that stock is underpriced and we give a buy recommendation on that stock. So if ER is greater than RE, we give a buy recommendation. Now the question is, how do we calculate RE? So for calculating RE, we use a very popular model that's called as CAPM, that is capital asset pricing model. Now the question is, what is capital asset pricing model equation? It is RE is equal to RF plus RM minus RF into beta. RE is equal to RF plus RM minus RF into beta, where RF is equal to risk-free rate. Keep listening guys carefully. RF is equal to risk-free rate. What is risk-free rate? The risk-free rate is the rate which we expect from government securities, because investing in government securities is the most safe investment anybody can do, because there is no risk of default in this. What is RM? RM is the return from the market. For market, we can be directly provided with the return, or we might have to consider the change in the value of Sensex or Nifty and take that as RM, because return from the market means what? We use a representation of the market and we use index like Sensex or Nifty for that purpose. So RM is basically given to you in exam. If it is not given, then in that case guys, we calculate it as a return on Sensex or Nifty. Maybe change 6 months value of Sensex 6 months earlier and 6 months later values will be given. Based on that, you can calculate the change in return and use that value. The difference between RM and RF is referred as MRP. You remember that, which is market risk premium. So sometimes they might give you directly the market risk premium data, and if they give you the market risk premium data, then in that case you directly take that as gap of RM and RF. Now the question is, what is beta? Before you understand what is beta, you need to understand how risk is computed in finance. So if you remember, I told you, first of all, what is risk? Risk is the deviation of actual from average. Any deviation of actual from average we refer as mean or X bar. We did more detailed discussion on this in portfolio management. The deviation of actual from average is referred as risk in finance. How do we calculate this? This is calculated by using variance. But there was a problem with variance. Remember what was the problem with variance? The problem with variance was that it is represented as percentage square, which most of us are not very comfortable with, because we don't talk in day-to-day life also, we don't talk in percentage square. You don't say my score in SFM is 800 percentage square, or you don't say that this year I got a salary hike of 100 percentage square. We always love talking in terms of percentage. So we understood risk is basically the deviation of actual numbers from the average. Deviation can be both favorable or adverse, but the point is, average values are calculated, average expected values or mean values. Actual values might deviate from the average expected values. This deviation of actual values from average expected value is referred as risk in finance. We capture risk using variance. How variance is statistically calculated to be discussed in portfolio management, but we had a problem with variance. The problem with variance is that it is expressed in percentage square. So what we wanted is to convert it into more easily interpretable form. So what we did, we introduced standard deviation, which is basically root over of variance. So standard deviation is root over of variance, and once we do that, we get percentage from percentage square. So standard deviation is a measure which will capture risk in percentage form. I hope you remember this guys. Okay, and then we started using standard deviation. Now the thing is, this standard deviation is made up of two things. One is called as systematic risk, the other is called as unsystematic risk. Systematic risk is this risk which is part of the system and nobody has control over it. The best example is coronavirus breakdown, or the best example is trade war between China and USA. These are examples of systematic risk. Crude oil prices going up, or crude oil, best example right now, crude oil prices going down. In fact, crude oil prices also became negative for the time being. So these are some of the systematic risks which are global issues, macroeconomic factors, bad monetary policy, demonetization, GST introduced as a new tax reform. These are examples of systematic risk. The question is, does anybody have control over it? Answer is no. Nobody has control over systematic risk. Systematic risk, I tell you to remember like this. Systematic risk is the risk which is part of the system. You can't do anything about it. So systematic risk is non-diversifiable risk. Systematic risk is non-diversifiable risk, which means you cannot eliminate it. It will be part of the system, and accordingly this systematic risk is relevant for us. Who says this? It is relevant. CAPM model says that systematic risk is relevant because nobody can do anything about it. Unsystematic risk is the risk relevant for a particular company. only specific companies have exposure to it. Example of unsystematic risk: poor corporate governance of a company, example Kingfisher Airlines. Or there is mismanagement of companies affairs, like what happened in case of Satyam scam. So these are some examples of unsystematic risk. Can they be diversified? Can they be eliminated? Yes, a rational investor can eliminate unsystematic risk. A rational investor can eliminate unsystematic risk by holding a well diversified portfolio. A rational investor can eliminate unsystematic risk by holding a well diversified portfolio. What does that mean? That means if an investor is putting his money across different stocks, he's not concentrating his money in one particular stock, then he will be able to eliminate unsystematic risk. Accordingly, this standard deviation, which is made up of systematic and unsystematic risk, CAPM says that only systematic risk is relevant for calculation. We don't want to capture unsystematic risk. So this systematic risk which CAPM wants to capture, it introduced beta to capture this systematic risk. So beta is basically used as a representation of systematic risk in CAPM equation. That's why in CAPM equation this beta is basically capturing the systematic risk. Unsystematic risk did not find place in the equation of CAPM, because CAPM model was very clear about it, that any rational investor should not be exposed to unsystematic risk. You need to be intelligent enough to understand that you should not invest all your money in one stock and accordingly get exposed to its unsystematic risk. Okay, so that is why this is how the equation of CAPM is designed. I hope now the equation is clear. RF is the return from government securities, RM is the return from the market. RM, if not given, can be calculated as a change in value of Sensex or Nifty. Beta represents systematic risk. Unsystematic risk in CAPM is of no use, no relevance, because it can be eliminated by holding a well diversified portfolio. RM minus RF can also be referred as market risk premium. If market risk premium is given, you directly put that value and do not write it as RM minus RF. I hope guys this part is clear. Now the question is, what is the interpretation of beta? We are not talking about calculation of beta. Calculation of beta also I will tell you, but right now we are talking about interpretation of beta. So if suppose for a stock beta is given as 1.5 times, it means that for 1% change in market return, stock return is expected to change by 1.5%. So if you remember, like this we discussed in class, a beta value close to 1 is called defensive stocks. A beta value for a stock close to 1.5 or greater than that is called aggressive stock, and anything between that is moderate level of risk. When we say beta is 1.5 times, it means stock is running compared to market at 1.5 times the speed. The speed is both for positive movement and for negative movement, which means if the market return goes up by 10%, then stock return is expected to go up by 10 into 1.5, which is 15%. But that also means that if market return comes down by 5%, then stock return is expected to come down by 7.5%. I hope guys this is clear to you. So beta being on a very high side is considered as aggressive beta stocks, and beta close to 1 is considered as defensive beta stocks. Another example is, if market return goes up by 20% but stock return goes up only by 10%, then what is beta of the stock? Beta of the stock is change in stock return divided by change in market return, which is 10 divided by 20, which is 0.5 times. Beta is only 0.5 times in this example, and which makes us clearly understand that it's a defensive stock. So beta is basically change in stock return divided by change in market return, and we take it as 10 by 20 in this example, so it is 0.5. Okay, now if they ask you to calculate beta of the portfolio, then we calculate beta of the portfolio as summation wx divided by summation w. I hope you remember this formula guys. Beta of the portfolio is equal to summation wx divided by summation w, where w is the weights, and weights are assigned to the market value of investment in each stock, and x is the respective beta value. W is the weights which is assigned to the market value of investment in each stock, and x is the respective beta value. So we do it summation wx by summation w, and that way we can calculate beta of the total portfolio. If I have more than one stock in my portfolio, then I can calculate the total overall beta of my portfolio. Now coming back to, I hope this entire discussion is clear guys, whatever we discussed in last 15 minutes. This background is very important in the class also. I told you this background is very important. It not just helps you in this chapter, it helps you in equity analysis, it helps you in M&A, it helps you in portfolio management most importantly, and even to some extent it helps you in mutual funds, this entire discussion. Now the question is, coming back to our main point of discussion, how to adjust beta of the portfolio using futures. How to adjust beta of the portfolio using futures. Before we do that, the first important thing to know is why adjustment of beta is required. Why adjustment of beta is required? The reason is this. Suppose right now the beta of your portfolio is 1.5 times, and you can be bullish on the markets or you can be bearish on the markets. You can be bullish on the markets or you can be bearish on the markets. If you are bullish on the markets and you expect market return to be 10%, if you don't do anything, then you expect that portfolio return will be 10 into 1.5, which is 15%, correct? But the idea is that if we already know that that markets are going to go up and we are bullish on the overall market, we don't just want the returns to be 15%. We will try our best to maximize the returns, isn't it? We'll try to maximize our returns in that case, and in that case beta adjustment is required, which means what I can do is I can actually try to change the beta of my portfolio to 2.5, and if I am able to do that, how we do that is later on discussion. But if I am able to do that, and suppose if then market return is 10%, then for me my portfolio return will be 10 into 2.5, which is 25%. Guys, I hope you understood the logic of it. Okay, so if we are bullish and existing beta is 1.5, obviously we will try to increase the beta, make the portfolio a little more aggressive, so that if market return actually goes up, we are able to maximize our return. Everybody wants to maximize return. You won't say no, I'm satisfied getting 15%. People who are satisfied in life, they don't come to equity markets. Come on, we have already done a lot of discussion in the class. People always try to maximize the returns, right? So you can increase the beta. So this 2.5 basically in exam will be provided. You don't have to take hypothetical numbers. They will give you how much the target beta is, and accordingly you will get the answer. Okay, and on the contrary, if we are bearish about market, then what we are worried about is that if market return goes down by 10%, then my portfolio return can go down by 10 into 1.5, which is 15%. So in this case, existing beta is 1.5. Maybe I'll try to take my target beta to 0.5. If I can do that, then in that case I will only lose 5% on my portfolio and not 15%. So what we understood is that why adjustment of beta is required, that we have understood. We might have a bullish belief or we might have a bearish belief. One thing is very clear, sir. If we have a bullish belief, we will try to increase the beta. If we have a bearish belief, we will try to reduce the beta. If we have a bullish belief, we will try to increase the beta of the portfolio. If we have a bearish belief, we'll try to reduce the beta of the portfolio. This part is clear, guys. After that, we discussed there are 3 different methods for increasing or reducing the beta of the portfolio. That is, for beta adjustment of the portfolio, there are 3 different methods. 2 are less important, which are not related to futures, and the third one is most important, which directly deals with the future strategy. So the first method was trading in stocks. What does that mean? Trading in stocks, very simple. If you want to increase the beta, you should shift funds from low beta to high beta stocks. You remember that, guys? If you want to increase the beta of the portfolio, you will shift funds from low beta to high beta stock, because you know beta of the portfolio is a weighted average beta with weights being assigned to the market value of investment in each stock. So obviously if you put more money in the high beta stocks, automatically beta of the portfolio will go up, and if you put money in low beta stocks, then beta of the portfolio will come down. So when would you like to put more money in the low beta stocks? Obviously when you are anticipating markets will go down. So if you expect markets to go up, you can shift funds from low beta to high beta stocks, and if you think markets will go down, you can shift money from high beta to low beta stocks. This way you can make adjustments of the beta so that your portfolio does not suffer huge losses, and in profits in case of bullish markets, your portfolio can make a lot of profits for you. But why this method is not much preferred is because every time you want to adjust beta, you need to keep reshuffling your portfolio, selling high beta stocks, buying low beta stocks, or vice versa. In that case, what happens is there are a lot of implications. One, there is active management of the portfolio required. Second, the brokerage cost will be too high, service cost will be too high. And third, you will end up paying taxes, because now you know both short-term and long-term capital gains are taxable in India. So that is another problem in this method. The second is you can make some risk-free investments. Now obviously risk-free means there is no risk involved. So beta of risk-free securities is 0. Beta of risk-free securities is 0. So what we can do is, if you want to reduce the overall beta of the portfolio, what we can do is we can shift some money from high beta stocks into risk-free securities. We can shift some money from high beta stocks into risk-free securities. Because beta of risk-free securities is 0, so the overall beta of the portfolio will automatically come down. Okay, I hope you understood. So there are two ways you can put money in risk-free securities. Either you can make fresh investments from your home, you can put some money in the risk-free assets, or you can take out money from high beta stocks and put some money in risk-free securities. This way you can reduce the beta of the portfolio. And last method, which is the most important method for us, is to trade in futures. The beauty of this method is that this method does not disturb the existing portfolio. This method does not disturb the existing portfolio. Your existing portfolio will be as it is. We don't disturb the existing portfolio, but what we do is we create position in futures to achieve the target beta. I'm repeating myself, listen carefully. We don't adjust or we don't disturb the existing portfolio. What we do is we create position in futures to achieve the target beta, which means if you are bullish on markets, leave your portfolio as it is, but what you will do is you will take F plus on futures. And on the other hand, if you are bearish on markets, if you're bearish on the overall market performance, then you leave your portfolio as it is and you can go short on futures. Now the question is how many contracts we should take. If you remember guys, from the maths we developed a formula in this case, and the formula was very simple, which is given like this. I hope you remember this. X is the number of contracts of futures which we should take to achieve target beta. X is equal to VP, which is value of the portfolio, into target beta minus portfolio beta, divided by F into M into beta F. X is equal to VP bracket target beta minus portfolio beta divided by F into M into beta F. I told you certain things. If they don't say anything, take target beta as 0. If they don't say anything, take target beta as 0. If they say completely hedged portfolio, take target beta as 0. If they say completely hedged portfolio, take target beta as 0. And beta of the futures, nothing said, we take it as 1. Beta of the futures, if nothing is said, we take it as 1. Okay, so this is the formula guys which we use for calculating the number of future contracts that we should take for achieving the target beta. Once you do this, sometimes they might ask you to substantiate your answer. Then I hope you remember that we write like this, that suppose market falls by 10%. If market falls by 10%, what happens to my portfolio? You show the calculations on the left hand side, and on the right hand side you show how futures are able providing you the hedge. And then at the end we give a proof that change in portfolio return divided by change in market return, and we prove that hence target beta is achieved. So this is the formula guys which we use for calculating the number of contracts. One last thing in this discussion was, what if cash is given? I told you it is up to the student to decide whether they want to take cash as part of the portfolio or not. But my suggestions were like this, that if they give you cash and they ask you to calculate beta of the portfolio, you can write a note that cash being idle money, we are not taking it as part of the invested portfolio. Cash being idle money, we are not taking it as part of the portfolio. Alternatively, cash could have also been taken as part of the portfolio. This is a diplomatic note you should write. If for a portfolio which has cash in it, beta is already given. If for a portfolio which has cash in it, beta is already given, I told you that you can write a note over there. We assume that the beta value which has been given, is computed without considering cash. We assume that the beta value of the portfolio which is given is computed without considering cash. Okay, and third thing I told you is, suppose they give you the equity beta of the portfolio. Equity beta of the portfolio is given and they ask you to calculate total beta of the portfolio. Equity beta of the portfolio is given and they ask you to calculate total beta of the portfolio. Then in such cases you can take cash in it. Okay, because they are asking you total beta of the portfolio. So in the portfolio cash is also there. Then in that case you can take beta by considering cash component also. Obviously for cash the beta will be 0. Okay guys, I hope this part is clear. So with this we are done with the futures, and try to read the notes and then see some questions also in your book, like the master problem we have done for this particular discussion. That master problem you should see, which covers all the 3 different methods in one problem we have done, and I have written in the class also master problem. Go through that. Okay, now I'm not starting with options now, because options I want to start in a fresh class. So what I'm doing is I'm starting with FRA, because this is a small part of discussion, so we can do this part of discussion, and then we will do options and cap flow collar like that. FRA, if you remember guys, we have discussed is a forward rate agreements. Like we have forward contracts on currency, about which we discussed in the entire forex chapter. Like we have forward contracts on currency. Similarly, forward contracts on exchange rate. Similarly, we have forward rate agreements. These are again the OTC derivatives. because they are very similar to forward contracts, and forward contracts are available from the bank is the market maker. Similarly, FRA is also a OTC derivative with underlying asset being the interest rates. These are based on interest rates, okay, and it is again available from the bank. These are OTC derivatives and it is interest rate derivatives where underlying is the interest rate. So let's say this is how the FRA quotation is given by SBI. 3 into 6 FRA is equal to 9% oblique 10%. Suppose this is the quotation of SBI. 3 into 6 FRA is equal to 9% oblique 10%. I told you there are 5 things in total you need to remember. 5 things. You remember that, guys? When is it available? It is available today. It is available today. It is available today. If you go to the bank and tell that I want a FRA quotation, probably they are giving you this quotation today. But is it applicable today? No, it's not applicable today, but it is available in the market today. It is available today, number one. Number two, when is it applicable? When is it applicable? It is applicable after 3 months. It is applicable after 3 months. What is the validity? Validity is 6 minus 3, 3 months. 6 minus 3, that's how we do it. 6 minus 3, after 3 months for 3 months. After 3 months for 3 months, this is valid. And when is the expiry? Expiry is at the end of 6 months. And when is the settlement done? Settlement is done at the end of 3 months at present value. Settlement is done at the end of 3 months at present value. Let's repeat it. When is it available? Available is today. Applicable after 3 months. Valid for 6 minus 3, 3 months. Expiry after 6 months. Settlement at 3 months at present value. Now what we do is, in order to calculate the profit or loss, what we do is we compare it with LIBOR or MIBOR rate. So MIBOR will be taken after 3 months for 3 months. That you need to be very careful. It should be available after 3 months and applicable for 3 months, because my FRA quotation is also valid for 3 months. So the MIBOR rate which you will take after 3 months should be a 3-month rate. You can't compare it with 6 months rate or 9 months rate. You need a MIBOR rate after 3 months for 3 months for comparison. And obviously the principle involved here is notional principle. The principle is not real. There is no borrowing or lending happening at this rate. We are only going to use notional principle for calculating the amount of profit or loss. Suppose notional principle is rupees 5 lakhs and after 3 months, the 3 months MIBOR is 11%. Let's assume that 11%. Just trying to show you how maths is done. Suppose in this case one person was bullish on interest rates. If you're bullish, obviously you will buy. So a person who is bullish on interest rates will buy this FRA, and if you buy, you always buy at a higher rate. Remember like that. That's the most logical way of remembering. Whenever we are bullish on interest rates, whenever we are bullish, we buy the asset. So in this case also, if I'm bullish, I will buy the FRA. If I buy this FRA, then the rate applicable will be higher of the two. That is, I can buy this FRA at 10%. I buy this FRA at 10%. Think of it like this, that after 3 months, after 3 months for 3 months, after 3 months for 3 months, I can borrow at 10%, a notional principle of rupees 5 lakhs. After 3 months for 3 months, I can borrow at 10%, notional principle of rupees 5 lakhs. And if the actual rate in the market happens to be 11%, then obviously you will be happy thinking like this, that I have a right to borrow at 10%, but in the market people are borrowing at 11%. This is only for thinking purpose, because if you buy something at 10% and if the rate becomes 11%, obviously you make a profit. So how much is the profit amount? There are two things we need to calculate, guys. One is the profit amount and one is the settlement amount. Profit in this case is 5 lakhs into 11 minus 10% into, it is valid only for 3 months, so you need to convert it into 3 months equivalent. 5 lakhs into 1% into 3 by 12. Let's just assume that this comes to 1250 rupees. Let's assume, okay, I'm writing it here. Later on you will start sending messages that you have calculated wrong amount. So 1250 assumed, okay. Then what you do is you calculate present value at t is equal to 3 months. Present value at t is equal to 3 months is 1250 divided by, what we do is from 6th month, this money is available at 6th month, but you generally get it at the end of 3rd month, and that is the settlement amount. That is what we refer to as settlement amount. So settlement amount is payable at t is equal to 3 months, which is 1250 into 1 plus, now we always use the market rate to do the discounting, so which is 1 plus 0.11 into 3 by 12, which is, let's say, 1125. Again, I'm writing it, say, suppose that is the amount. So bank will pay you this money. Bank will pay you this money. Very simple, guys, very simple. FRA is quite simple stuff, right? Only problem you can face is with interpretation of the quotations, and for that I told you, remember these 5 key things. Let's see one more example that will make you completely clear about the concept. let's say this quotation 6 into 12 FRA is equal to 5% oblique 6.5%. 6 into 12 FRA is equal to 5% oblique 6.5%. Interpretation first of the quotation. When is it available? Available is today. When is it applicable? Applicable after 6 months. How long is it valid? It is valid for 12 minus 6 equal to 6 months. 12 minus 6 equal to 6 months. When is it expiring? Expiring at the end of 12 months. But when will the settlement happen? Settlement will happen at the end of 6 months at present value. Settlement will happen at the end of 6 months at present value. Anybody who is bullish on FRA, anybody who is bullish on FRA can buy this FRA. If you buy this FRA, then the rate applicable is 6.5%. Anybody who is bullish can buy this FRA at the rate of 6.5% and will be betting that after 6 months, the 6 months LIBOR, after 6 months LIBOR should be greater than 6.5%. Then you will be happy if you buy this FRA. If you are a buyer, then this is what you want. After 6 months, the 6 months LIBOR should be greater than 6.5%. If you're a seller of this FRA, seller means you're bearish. If you're bearish, you will sell this FRA, and whenever you sell to the bank, you sell at a lower rate. So 5% is what you can sell at, and you will be happy in this case. If after 6 months, the 6 months LIBOR is less than 5%, then you will be happy. Clear? After 6 months, if the 6 months LIBOR is less than 5%, then you will be happy. Clear? So you calculate the profit or loss looking at the rate after 6 months for 6 months, and then you discount it for 6 months using the market rate, guys. Always remember that we always do the settlement by discounting at the market rate, not at the rates given in the FRA quotation. Next question which I told you can come from this is the speculation using FRA. Speculation using FRA is very simple. A trader on interest rates can be bullish or bearish. A trader on interest rates can be bullish or bearish. If you are bullish, you're betting on interest rates going up, you will buy the FRA. If you buy the FRA, you will take the higher of the two rates. If you are bearish on interest rates, then you will take the FRA at you will sell the FRA, and you will always sell at a lower rate, because you can always sell to the bank at a lower rate. So speculation part is clear. In speculation part, remember two things. One is that you need to calculate the profit or loss at the expiry, and second is you need to calculate the settlement amount by discounting the cash flows at its present value using the market rate, that is the LIBOR or MIBOR rate. Another time, I am repeating it one more time, the principle involved in the FRA is notional principle. That is, it is only used, that is principle is only used to compute the profit or loss. There is no exchange of money happening, no actual lending or borrowing is happening at the FRA rates. Next, last part is that they can ask you questions on hedging using FRA. In case of hedging using FRA, basically you need to think two questions again: what is my risk and what am I afraid of? Again, if what is my risk? Suppose if I'm talking about a borrower, then in that case, what is my risk? I'm worried about interest rates going up in 6 months time. Suppose after 6 months I want to borrow for 6 months, so as a borrower I'm worried that in 6 months time interest rates can go up. What can I do with FRA so that even if interest rates go up, I make money from it? Obviously, as a borrower, what you can do is you can buy the FRA. So you can buy this FRA at 6.5%. The biggest advantage of buying this FRA at 6.5%, if you remember this, guys, is that once you buy FRA at 6.5%, then your cost of loan after 6 months for 6 months will be 6.5%. Your cost of loan after 6 months for 6 months will be 6.5%, which means when you get a sum on hedging using FRA, you already know the answer beforehand. The rate at which you take the FRA for hedging, that rate itself becomes your locked in cost or return. In this case, my cost will be fixed at 6.5%. I told you basically these sums come in exam to check how you present your answer. So suppose if a person is going to borrow after 6 months for 6 months and this FRA quotation is given, then you will write it that since we are worried about interest rates going up, so we can buy this FRA at 6.5%. Once we buy this FRA, we are locking in our cost at 6.5%. But how do you show the presentation? Because see, borrowing using FRA is not possible. So after 6 months, whatever MIBOR or LIBOR rate is given, you will do the borrowing at that rate and you calculate your interest cost. On FRA, you will only calculate the profit or loss. Very similar to futures. On FRA, you will only calculate the profit or loss. Once you make adjustment of this profit with the interest outflow, in that case, you will find out your effective cost, and by default, your effective cost will come to 6.5%. Similarly, if we are an investor, then in that case, we are worried about interest rates going down. That is, after 6 months, for 6 months, we are worried about interest rates going down. In that case, what you can do is you can sell this FRA at 5%. If you sell this FRA at 5%, by doing this you are again locking in your investment rate at 5%. No matter what, you will get 5%. So what exactly happens is, after 6 months you will actually invest at the market rate of LIBOR or MIBOR, but you can use the FRA only for profit or loss. Once this profit or loss is adjusted against your interest income from the market, you will find that your effective return will come to 5%. Effective return will come to 5%. Apart from that, one last topic of discussion which we did in FRA was pricing of FRA. And as far as pricing is concerned, I told you the 3-month LIBOR is given as 9%, the 6 months LIBOR is, let's say, given as 11%. So if you remember, I told you, if suppose I tell you what is the price of a 3 into 6 FRA, a theoretical 3 into 6 FRA price, if they ask you to calculate, then how do we proceed in this case, guys? I told you certain steps. First of all, you need to understand, when you see 3-month LIBOR, 6-month LIBOR, you need to remember this, that the rates are always given on per annum. 3 months and 6 months only represent the period at which resetting of LIBOR rate will happen. Rates are always per annum. 3 months and 6 months represent the period at which resetting of rates will happen. That is, the rate will change every 3 months. That is the meaning of it. So in this case, if 3 months LIBOR is 9%, then I told you what first you do is you calculate a 3-month periodic rate. That is, you convert this into 3 months equivalent rate, which is 9% into 3 by 12, which is, let's say, 2.25%. And similarly, the 6 months periodic rate also we will calculate, which is 11% into 6 by 12, and we get 5.5%. Once you do this, then you make a factor of this, which is 1.0225, and we can make a factor of this, which is 1.055. So we make a factor for 2.25%. First, you calculate periodic rate based on the period of resetting of LIBOR, which is 9% into 3 by 12, 11% into 6 by 12. Once you calculate the periodic rates, then you make a factor of it. Now we need 3 into 6 FRA. So what we do is the bigger factor, that is 6 months factor, divide by the 3 months factor. This is how we do it, minus 1. From the bigger factor, we remove the smaller factor, and this is your answer for 6. See, from 6 we remove 3. From 6 we remove 3. From 6 we remove 3, so we get answer for 3 months. That is, after 3 months, the rate for 3 months. From 6 months rate, if we remove the 3 months rate, then we get the answer for the remaining 3 months, and into 12 by 3 we do, because this is the answer for 3 months. Then how much is the answer for annual basis? How much is my answer on annual basis? That is what we calculate in this way. And apart from that, guys, we have done how pricing of the FRA can be used for calculating arbitrage, can be used to do arbitrage opportunities. Arbitrage related sum I've done in the class, but it has never come in the exam, so that I think you can just go through it. Once you calculate, you need to use this approach. Once you calculate the theoretical 3 into 6 FRA, then you need to compare it with the actual 3 into 6 FRA. And just remember one thing, if actual is greater than theoretical, if actual is greater than theoretical, it means FRA is overpriced. And if FRA is overpriced, then we would like to borrow at the FRA rate and not invest. If actual rate of FRA is greater than the theoretical rate of FRA, then we say that FRA is overstated. And if FRA is overstated, to conduct arbitrage, we will borrow using FRA. On the contrary, if actual FRA is less than theoretical FRA, then we conclude that FRA is underpriced, and in such case, we would like to borrow using FRA because it is underpriced, and we invest in the market. So we borrow using FRA and we invest in the market, or we borrow from market and we invest in FRA. These are the two treatments that we do. Total arbitrage is covered in 3 steps. If you see, 3 steps are there. FRA will allow you to borrow or invest on a later date. So today, once you need to borrow or invest in the market, then on a later date you will use FRA, and then whatever money you get, that money will be either invested or borrowed from the or in the market. Accordingly, we have to calculate the arbitrage profit. 3 steps are there in that. Okay, so what all did we cover in today's class? Pricing of futures, beta, basic idea about beta, RE, CAPM, beta adjustment of the futures with 3 different methods, the formula of the same. Then we did FRA basics, FRA hedging, FRA speculation, FRA pricing, and an understanding about how FRA arbitrage can be done. Okay, so 3 topics are left. Options, I will be doing options in my next class. After that, cap floor collar after the options we have to do because they're related to options. And lastly, we will close it by doing financial swaps. I hope the video is useful, guys. If you like it, please leave a thumbs up and mention something in the comment. That really boosts my energy levels, and I'm determined in that case that I have to make videos because they are actually helping somebody out there. Thank you, guys. Bye bye. God bless. Stay safe.